Welcome to Future Epoch, where we learn more about our world. In January 2021, a group of amateur investors on an internet forum did something that was supposed to be impossible. They targeted one of the most powerful hedge funds in America, drove the price of a struggling video game retailer to extraordinary heights, and briefly turned the entire financial establishment upside down. It was called the GameStop short squeeze. And when it was over, a trading app that had promised to democratize finance found itself at the center of one of the most controversial decisions in the history of retail investing. To understand what happened, you first need to understand two things: short selling and why so much of it was concentrated on a single struggling company. Short selling is a bet that a stock will fall in value. An investor borrows shares, sells them immediately, and hopes to buy them back later at a lower price, pocketing the difference. It is a legal and widely used strategy, but it carries a specific vulnerability. If the stock rises instead of falls, the short seller must eventually buy the shares back at the higher price to return them, and the higher the price climbs, the greater the loss. Unlike a conventional investment, the downside of a short position is theoretically unlimited. By the start of 2021, GameStop was one of the most heavily shorted stocks in the entire American market. The company operated physical retail stores selling video games at a time when the gaming industry had moved decisively toward digital downloads and online storefronts. Professional investors, including several major hedge funds, had concluded that GameStop was a company in structural decline and had placed enormous short bets against it. At certain points, the short interest on GameStop exceeded 100% of the shares available to trade in the public market, meaning investors had collectively borrowed and sold more shares than actually existed in the float. The chain of events that followed began well before January 2021 on a subreddit called Wall Street Bets. The community, known for its chaotic humor and appetite for high-risk trades, had been watching GameStop for months. One member in particular, Keith Gill, posting under the username DeepFuckingValue, had been arguing since 2019 that GameStop was fundamentally undervalued and that the short position against it was dangerously exposed. Gill had invested approximately $53,000 of his own money into GameStop call options and shares, and he documented his position openly and in detail on the forum. By the third week of January 2021, his thesis was becoming a self-fulfilling event. As Wall Street Bets members bought shares and options in significant numbers, GameStop's price began to rise. Rising prices forced short sellers to buy shares to cover their positions, which pushed the price higher still, which forced more short covering. This feedback loop, known as a short squeeze, accelerated at a speed almost no professional observer had anticipated. GameStop's stock closed at around $17 on January 4th. By January 27th, it had reached nearly $350 per share. At its intraday peak on January 28th, it briefly touched $483. Melvin Capital, one of the hedge funds most exposed to the short position, lost approximately 53% of its value in January alone, requiring a nearly $3 billion emergency infusion from Citadel and Point72 just to remain solvent. What had begun as a discussion thread had produced one of the most dramatic hedge fund losses in recent memory. Then, on the morning of January 28th, Robinhood did something that made it the most controversial company in America almost overnight. The platform halted all purchases of GameStop and around 50 other heavily shorted and volatile securities. Users could sell their existing shares, but they could not buy more. The restriction sent GameStop's price sharply lower within minutes. The public reaction was immediate and furious. Millions of ordinary investors who had positioned themselves in GameStop concluded that Robinhood had acted not to protect them, but to protect the hedge funds that were losing money. The accusation of collusion spread rapidly and was stated by many, including some elected officials, as established fact. Robinhood had coordinated with Citadel, the market-making firm that both processed Robinhood's trades and had provided the emergency capital to Melvin Capital, to shut down the retail surge and rescue Wall Street from the consequences of its own bets. Robinhood's actual explanation was more procedural than conspiratorial, though the company's slow and initially vague communication made the situation considerably worse. The platform said it had received a deposit call from the Depository Trust and Clearing Corporation, the organization responsible for clearing and settling stock trades across the United States. Because of extreme market volatility, the DTCC had required Robinhood to post approximately $3 billion in additional collateral, an amount the company could not immediately meet. To reduce those collateral obligations to a manageable level, Robinhood restricted trading in the most volatile securities on its platform. The company raised more than $1 billion in emergency capital from its existing investors within 24 hours, and began restoring buying access the following day. But the damage to its reputation had already been done, and the explanation arrived too late to prevent the narrative of deliberate sabotage from taking hold. In February 2021, the House Financial Services Committee convened a hearing into the events. Keith Gill, appearing in his now recognizable red bandana, testified before Congress that he had made his investment decisions independently based on his own research and analysis, and had not coordinated with any organization. Vlad Tenev, Robinhood's chief executive, testified in detail about the collateral requirement, and denied categorically that the decision to restrict trading had been made to benefit any hedge fund or market maker. Representatives from Citadel, Melvin Capital, and Reddit also appeared before the committee. The hearing produced considerable political heat and some genuinely pointed questioning, but it reached few formal conclusions. The Securities and Exchange Commission published a detailed staff report on the episode later in 2021. It found no evidence that Robinhood had restricted trading in coordination with Citadel, Melvin Capital, or any other financial institution. It confirmed the collateral explanation as the primary driver of the January 28 decision. But the report also raised pointed questions about payment for order flow, the business model that sits at the foundation of Robinhood's commission-free trading promise. Payment for order flow is an arrangement in which Robinhood routes its customers' trades not directly to open exchanges, but to wholesale market makers, principally Citadel Securities, in exchange for payment. The market maker profits from the small spread between the buy and sell price of each transaction. Critics argue that retail investors systematically receive slightly worse prices as a result of this routing, and that the arrangement creates a structural conflict of interest. Robinhood's revenue depends on keeping its users actively trading, not on securing the best possible execution for each individual trade. The SEC report identified payment for order flow as an area warranting serious regulatory attention. Regulators in the United Kingdom and several European countries subsequently moved to restrict or prohibit the practice. In the United States, reform efforts stalled and the debate remained unresolved. Robinhood went public on the Nasdaq in July 2021. Its IPO was priced at $38 per share, valuing the company at approximately $32 billion. The stock fell sharply on its first day of trading and continued declining in the months that followed, closing out the year well below its offering price. What the GameStop episode exposed was not simply the story of retail investors beating hedge funds, though that did happen in spectacular fashion. It exposed the hidden infrastructure of modern markets, the clearing systems, the collateral requirements, the payment arrangements, and the profound gap between what a trading platform promises its users and what it is actually designed to do under pressure. Millions of people discovered, at the precise moment it mattered most, that the democratization of finance marketed by Robinhood came with terms and conditions they'd never read. The platform could restrict trading at a moment's notice for reasons entirely structural and divorced from any accusation of fraud or illegal activity, and the user had no recourse in the moment. The short sellers suffered enormous losses. But many retail investors who bought near the peak and held through the collapse suffered serious losses too. GameStop's price had risen not because of any fundamental change in the company's business, but because of a self-reinforcing feedback loop of momentum, media coverage, and financial mechanics. When that momentum reversed, the price fell with nearly the same velocity it had risen. But GameStop's story has not ended. Keith Gill returned to social media in 2024, and his reappearance alone was sufficient to trigger another substantial surge in GameStop's price, demonstrating that the conditions that produced the original event had not dissolved. Payment for order flow remains legal in the United States. Short selling remains legal. Retail investors remain, in many structural respects, at a disadvantage relative to the professional institutions they trade alongside. What January 2021 demonstrated was that tens of thousands of ordinary people, coordinating loosely through a public internet forum, could move markets in ways that had previously been the near-exclusive territory of professional capital. It also demonstrated that the moment the rules of that game became inconvenient for the infrastructure those ordinary people depended on, the game could change without warning and with little explanation. Whether that infrastructure requires reform, tighter regulation, or simply better disclosure to the people who use it every day is a question that regulators, politicians, and financial institutions are still actively debating. What is beyond dispute is that for a brief and extraordinary stretch of days in January 2021, the direction of one of the most shorted stocks in America was determined not by hedge fund analysts or trading algorithms, but by a Reddit thread. Thank you for watching. If you've enjoyed this content and want to see more, please consider liking the video and subscribing to the channel.